I'm actually a bit surprised at how strong the market's reaction has been to today's number. This was not a huge upside surprise by any stretch of the imagination. It may also be a response to just how overextended the move in the 10-year was just a few weeks ago. I mean, it's hard to believe, but we broke the 5-year yield point for the first time in decades just a few weeks ago, and the market is, at this moment in time, enjoying a pretty substantial rally from the lows in bond prices, high in yields, and today might be just a continuation of that momentum.
Now, do you think it's crazy then for people not to be buying at this point, given the move downward that we're seeing? Do you think that this move is sustained?
Look, I think any yield on the 10-year around this 4.5% number, plus or minus 50 basis points, is a reasonable number to be at. I think it's hard to argue that we're way off the market, no pun intended, on the current 10-year yield.
Now, what does this mean for the Fed? Do you think it would be a mistake for the Fed to take their foot off the pedal here, given what we're seeing in the inflation print, and even cut into next year like the market is expecting?
Well, so the question is, heading into next year, how fast do we cut? So if you look at where inflation is likely to print over the first half of next year, and unemployment's likely to head to somewhere in the low 4s, you're going to have monetary policy that's too restrictive under those circumstances. Now, the key, from my perspective, is the Fed needs to stay on message that they're going to put the inflation genie back in the bottle. And so if they cut too soon, I think they risk losing credibility around their commitment to a 2% inflation target. So, the market's pretty optimistic that we're going to head into an easing cycle next year. And I think the Fed needs to balance that with making sure they're able to stay on message that they're committed to a 2% target.